our week 4 update video. Today's date is Friday, November 18th, and you're in the process this week of completing your midterm examination. One part of that midterm examination is to update your portfolio of stocks as of today, November 18th. So you get the closing stock price of today and update your portfolio. More on the midterm examination in a bit. First of all, I'd like to talk about the topic of this week, capital valuation, bonds and stocks. And before that, a quick review of assignment number 2. The solutions and grades are posted in Blackboard. And let's just review a couple of key parts of that, which you'll need to use in your midterm examination and also in future work ahead in this class. So let's take a look at our assignment 2 review. Okay, the assignment 2 is basically determining your ability to do some time value of money calculations. This is the solution file posted to Blackboard, and also I have given you an Excel file on how I calculated these numbers, and we'll look at that file in just a minute. One of the key questions of the multiple choice was your ability to distinguish the information given to you to come up with the answer. And the first one was the best example of that. Each of these 4 problems are worth 15 points in this assignment number 2. What is the future value of $10,000 on deposit for 5 years at simple interest? The key there is simple interest, 6%. It's not being compounded annually, which would be the answer for letter D. Simple interest means you just take 13,000 times 6% times 5, and you get $3,000. Excuse me, $10,000 times 6% times 5, and you get $3,000. The correct answer is $13,000. I wanted you to be able to distinguish between simple interest and compound interest. Question 2 is asking you to determine the present value of $50,000 to be received in 7 years, discounted at a rate of 10%. Question 3 is asking you to determine the net present value of the present value of a series of cash flows. The key there is understanding when you receive the cash flow and how it is determined. $1,000 today, exactly today, $2,000 at the end of the first year, nothing, $4,000 at the end of the third year, nothing in year 4, and $6,000 in year 5. The correct answer is B. And then finally, if I had $120,000 being borrowed for a home mortgage at 9% over 30 years with monthly payments at being $965.55, how much interest is paid over that life of that loan? No need to calculate any interest or amortization schedules. All you need to do is just take $965.55 times 30 years times 12 months a year, or 360, and you get the total amount of payment over time. You subtract the principal, 120, and that's how you get the interest of $227,598. And the last question, question 2, was I was looking for some real world application of the time value of money, and I was naturally being specific about telling me how you calculated that information. How did you show me how that was an example of future and present value? 40 points for that question. Here's the spreadsheet answer sheet for assignment 2 for the question 1, those 4 problems on time value of money. And if you go to the cells, you'll see my formulas to calculate these. Notice I'm determining the net present value of years 1 through 5, but then I have to add $1,000 to it because that's being received now. Naturally, there would be no interest. The present value of $1,000 is $1,000. So I'd add that $1,000 to the NPV over the 5-year period of that cash flow. And that's how I got $10,412.27. So if you want to see how I calculate these numbers, please go to these cells and you can see the formulas used to obtain that information. Any follow-up questions on that, please let me know. But that should help you. But everybody did very well on this. Okay, we're back to that, to the review sheet for this week, looking over some calculations of bonds and stocks, just to get a feel for what they are. Remember, we define those as being bonds as a form of capital fundraising where the borrower is going to the public market and issuing in $1,000 lots debt. And that debt is determined by the coupon rate or the credit rating to determine the interest that was paid on that debt over a period of time. It's a non-amortized loan, meaning that it's interest only until the maturity. So let's take a look at something like this. Here's an example of a $1,000 bond. The company has a credit rating of BBB+, which is not that great. It's kind of average, I guess you could say. So their coupon on that bond is $70 or 7%. So if I take 7% of $1,000, there's my coupon of $70. So if I decide to lend my $1,000 to this company, I would get $70 every year for 10 years. And at the end of the 10 years, I would get my $1,000. All right, pretty simple. But what happens during the course of those 10 years, I decide to sell my bond, okay? So let's use this example. Let's say 2 years go by, and after 2 years, I decide to sell this $1,000 bond in the market. So I call up my broker, or I go to Robinhood, or I go to wherever in the market, I even go to my banker and say, could you give me the current yield on this 7% 10-year bond issued 2 years ago? And let's say they find out that the current yield on this bond is 8%. Now, what does that mean? It means that this same company, if they were to issue a new bond today, they would have to pay 8%, not 7%, to attract investors to lend them the $1,000. Okay, that's the current yield. In other words, either two things have happened or probably both. The company's credit rating has gotten worse, so they have to pay more for their money, or also, and which is prevalent these days, interest rates are going up. The overall market risk or market interest rates are going up, thus the company's interest rates go up to follow along with the general market. And that's what's happening today. In November of 2022, interest rates are going up, bond yields are getting higher. So what does that mean? Well, it means that this bond with the yield of 8% in the market is going to be sold at a discount. In other words, the bond has lost value. And let me explain that to you. If I go to formulas, function, financial, present value, and type in the current yield of this bond, which is now 8%, that's the current market yield, and there's 8 periods remaining. Remember, that's a 10-year bond, 2 years have gone by, so 8 years remaining, with a payment, a coupon current payment of $70. That's what you're buying. You're buying a 7% bond. That doesn't change. You always will get $70 a year, whoever's buying it or owns it. So the payment is $70 and the future value is $1,000. That's the maturity value that you get. So what this calculation is doing is determining the present value with 8 years remaining of a 7% or $70 coupon bond in a market of 8%. And as you can see, the market, the discount bond value is a less than $1,000. And that is called selling the bond at a discount. In other words, the person who's selling the bond is not going to get $1,000 for it, is only going to get $942.53. Now, the person buying the bond is going to purchase it for $942.53, but they're only going to get $70 a year, not $80. Okay. If you want to get $80 a year, then you'll have to find the bond at $1,000. But since the bond has gone up in the market, the value of the bond has decreased. And this is exactly what's going on in the bond market today. Interest rates are increasing. Existing bonds that have already been issued are losing value. And that's causing some problems in the markets. When interest increase, asset values in investments decline. And that's why the markets are spooked these days, because of higher interest rates. Let's take a look at the other side of it. What happens if the current yield is not 8%, but 6%, right? 6%. Formulas, function, financial, present value. Now the market yield is 6%, and everything else is the same. 8 years remain. The payment is still $70, and the future value at maturity is $1,000. Now look what happens to the price of the bond. It increases to $1,062.10. In other words, interest rates are now in the market below the coupon rate, which makes this existing bond at 7% more valuable. And that is called selling the bond at a premium over face value. And the premium is $62.10. So for the person selling the bond in this market, they're going to make a little bit of a profit. The person buying the bond is willing to pay $62.10 more for it in order to get $70 a year coupons. Instead of getting $60 a year, they're paying at a premium. And that's a perfect example of what's going on in the markets today. As yields increase, and what is the current market yield of bonds? It's usually the 10-year United States Treasury yield, the risk-free interest rate. As that risk-free interest rate increases, all bond values and current yields go up. As the interest rate or risk-free rate decreases or drops, bond values also, yields go down, their values increase. That's an important concept, because it tells you about how interest is tied to the value of the asset. Asset values increase when money is cheap, low interest rates. Asset values decrease when money is expensive, because that inflation or that higher interest rates is cutting into the return that you could get from the investment. And that's a very key point as we look at our economy and look at the way CFOs or financial managers are doing business these days. So that's a pretty good example of bonds and how interest is so key in the market to the relative value of the bonds. Now let's take a look at stocks. Remember, bonds are debt. Stocks are equity, ownership, okay? And one of the key things about stocks is you have no idea what the future is. In bonds, you know exactly what the future is. You know what your coupon payment is. You know what you're going to get at maturity. You know how long you have to wait until maturity. It's all right there. But in stocks, you have no idea when you buy a stock if you're going to get a dividend. Yes, you can look at past dealings or past trends of the company, but that does not guarantee you a dividend. But what you can also see is that you have no idea what the stock price is going to do in the future. It's all based on the performance and the market view of the management of the company. So let's say I'm a company issuing stock. The reason why I'm issuing stock is I can go into the capital markets and get a lot of big money from investors. Now, those investors are going to have demands, expectations. They want dividends. They want liquidity. They want stock prices to go up. They want returns. And if the company doesn't make those return expectations based on their market and their past, they're going to either sell the stock or want to make changes in the company's management. Remember, when you own stock, you are a manager. The management team works for you as a group of investors. That's why you have your board of directors who are stockholders who run the company. So that puts a lot of pressure on the financial management team. A couple definitions to come out of stock. Number one, the dividend, let's say, is $4, the stock price is $20, that makes the, that makes the dividend yield 20%. If somebody says the dividend yield on your stock is 20%, that's the dividend being paid for the current year divided by the current stock price of the company. Okay. The annual return on a stock is the dividend yield plus the capital gain. And you'll be doing this in your portfolio. In your final examination, you'll be determining the total return on your common stock, which will be dividends, if any dividends are paid during the time that you own the stock in these brief 8 weeks, which some of you will get some dividends, plus how your stock has appreciated in value from the original purchase price to the last purchase price that last week of the course. You'll be determining the return. Okay, so for example, if the stock price is sold at $22 and we paid $20 for it, that means we had a gain of 2%. All right, that's a capital gain of 2%. Whatever your dividend yield, add the dividend yield to the stock price, to the capital gain, and that's your total return on your stock. And that's what investors look for. They look for total return. Dividend plus stock appreciation. The bad thing about it is if you're an investor, you only get that capital gain when you sell the stock. And that makes for a whole different ballgame because now you no longer own it. So that's the game being played on the capital investment side of equity, is that equity shareholders demand returns, but you're only really going to get your return if you sell the stock. So how do you keep investors happy in your performance of your company and stock investors? You pay dividends. You show a gradual increase in the stock price. You maybe give stock dividends, and we'll talk more about that in another week. You maybe also split the stock, have the investor now have more shares of stock. So there's a variety of different ways that companies can do that, but it's a totally different ballgame from bond investors because they know what they're getting. They're getting a coupon and they're getting maturity value. Stock investors, you got to keep them happy 24/7. If not, they're going to make your life miserable. And that's the key definitions of stock. And finally, one last look of this weekend update video as the midterm examination is due on Sunday. Again, extensions are also available. This midterm examination is involving definitions of the first few chapters in multiple choice and calculations. You're updating your portfolio as of Friday, November 18th. That includes, as I mentioned in the Monday video, you're taking your original value of October 28th and copying it down and updating it as of November 18th, with your amount of stock shares, ownership of stock staying the same. The changes now in the price times your original stock share buy will give you the new value of your portfolio. Also, don't forget to take the new values of the Dow, the S&P 500, and the NASDAQ as of November 18th. And finally, a new wrinkle to your portfolio, tell me what the beta is. And we'll talk a lot about beta next week in our class. Beta is an indicator of market risk. Find the beta for your specific companies and put that into your portfolio. And then finally, part 3 is to take one company from your portfolio and do an analysis of how the company's capital structure has changed during the pandemic years, January 2020 to September 2022. How has the capital structure changed relative to your business? Now, you just pick one company from your portfolio, and probably, I would assume, is the company you selected in the first assignment. You've already done some work there for it. Probably go to that one, but it's your choice. And then write me a brief 2-page essay about how your company has changed in your interpretation, both in capital structure, maybe that's related to changes in the governance or the management of the company, and also maybe changes in the competitive markets. A lot of markets changed over the pandemic. Give me your interpretation of that in a 2-page essay, not to exceed 10 pages, as part 3 of the midterm. So a little essay work there for you. I'm around all weekend. Should you have any questions or concerns, some students have been following up with me this week, asking questions, so please do. I'm available. With that being said, that's it for today. Next week, we begin the second half of our class, and we're talking about capital investment project return. We're talking about determining whether an investment in an asset is prudent. How do we calculate that? It's called capital budget analysis, and that's where we pick up chapters 8 and 9 next week. So have a great weekend, everybody. Good luck on your midterm. And until next Monday, November 21st, adios.